Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But back to this point of confusing rationales. Soros talked about expectations and sentiment really being what is the driver here, because sentiment embodies all that stuff, and it embodies all these decisions and all these ideas from everybody out there. And because we can't forecast real world events, and because we can't forecast interest rates, what we really have to go on is sentiment and expectations across these major markets. Currencies, as I said, because there's a lot of confusing rationales out there, and there's a lot of self-reinforcing drivers of interest rates and growth and interest rates back and forth. And then if you layer in inconsistent rationales as other drivers, you tend to see a lot of money thrown into to trends for a lot of different reasons because it's working. And especially at the moment, most of the major players in terms of the commodity trading advisors and the big players in the world, the longer-term players in the currency markets tend to be price-driven, meaning they just use trending models. And as the trend works, they tend to throw more money towards the trend. And that's why you see this self-reinforcing process in currencies that you don't see in other markets. And you get very much this idea of overshoot. And we see it in all these different time frames. But again, there's where the meat or the crux of this comes in not only evaluating the reality of interest rates, but also evaluating sentiment. And that's something we can do. And that sentiment is another piece of the puzzle. Again, we can call it technical analysis, which is not really. It's really just analysis of the expectations in the market. And ultimately what we're looking for in these various time frames are sentiment extremes, and I'll give you some ideas of how to look at that. As much as I'd like to say there's one really holy grail indicator here, there really isn't, but I want you to think in terms of these interest rate terms, and I want to give you an example of one of the most invalid underlying rationales that's talked about in the currency world, more so than anything else. And let me see if I can grab a pen here. Try to find a pen. I don't see one. But this is a chart of the current account deficit, the dreaded U.S. current account deficit. That's referred to as balance on the current account. And this is a quarterly measure going back from 1972 on the left all the way up to today. And you often hear people say that, well, it's the current account deficit that's driving the dollar down. The simple point I want to make with this chart is that you really can't trade the dollar on the current account deficit at all. So the next time you hear somebody talk about the current account deficit, just get that out of your mind. The current account deficit means a lot of different things and can be portend some money flow factors, but ultimately it's not something you can trade the currency on. If you look from 72 to 1980, the current account went sideways. The dollar was in a pretty nasty bear market. From 1982 to 1985, from like 81 to 85, the U.S. dollar was in a massive bull market as the current account deficit was getting worse. From 1990, from 85 to 90, the dollar was in a nasty bear market as the current account deficit was getting better, which it shouldn't be if the current account is so important. From 92 to 2001, the U.S. current account deficit tumbled, got worse and worse, but the U.S. dollar staged a pretty massive rally during the 1990s from 1992 on to 2001. And then, of course, we have the period from 2001 on, U.S. dollar down, down, down. The current account deficits improved about 50% since beginning of 2007. If that's what if the current account were the whole thing, the U.S. dollar should have rallied sharply from 2007 on. It hasn't. So there's a lot of underlying rationales out here that economists and analysts constantly tout as drivers for the dollar. There's just a ton, we could spend all day going through the underlying invalid rationales out there. The point I want to make is just step back and just think about these things think about these things in terms of what works and what doesn't work. We talked about correlations, oil prices. Now the big thing, dollar. Yeah, in this cycle we've seen them pretty tight, but that'll probably change again in the near future. It's never been as tight as it was as it is in the last several years. There was never such a direct correlation. So again, be very, very careful. The things we do know that are always lingering in the background, the currency markets, are interest rates and interest rate differentials working on the currencies. That we do know. Inflation rates, we always know are working on the currencies. If the inflation is expected to rise considerably in a country, then the value of the country on the relative terms is going to depreciate against others that don't have high inflation. Those are the things that we do know, and that is about it. We can't forecast the future. We can't forecast what's going to go on in the financial or economic world. These are really the valid underlying rationales that we do know and that we can hang our hat on. We can expect something to go up if the perception of the trend or of the currency has stabilized, or we can visually see it's entered an uptrend and it has relatively high yield. A valid rationale for something continuing down is the currency has stabilized or entered a downtrend and there's relatively low yield. These are valid underlying rationales. Again, not always right, and I'll show you the interest rate rules. But even when we step back and I tell you about interest rates, the reality is there's no reliable direct link with interest rates because currencies usually lead interest rate movements. It doesn't mean we can't get a lot out of interest rates. It doesn't mean that we shouldn't understand the interest rate background, but we need to understand the interest rate environment, the expectations in the market of what interest rates are going to do in the future. There's where the gold is in this. And I know it sounds nebulous. The reality is it is nebulous. The reality is there is not a holy grail. And if you're looking for one, you're not going to find it here. So the media is following the crowd expectations, not trying to forecast events. Part of my problem and part of the things in terms of what we do is we get hung up on trying to forecast events and often try and talk about events in an interesting way and give the implication that we can forecast events, and if we do forecast them, we know exactly what the currency is going to do. Ultimately, none of us can have a crystal ball. What moves prices, what moves currency prices is surprise. Surprise against the crowd's expectations. So our goal here is really to zero in on the expectations on interest rates, expectations on inflations, and expectations about future growth rates, and see how surprise moves in currencies, and then get a handle on what the sentiment setup is.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.